Hey everyone, Alan Kinney, Editorial Director with REIT.com. Join me on the other end of this video conference is Keven Lindemann of SNL Financial. We're going to talk a little bit about REITs capital raising in 2013, then look ahead to 2014. So, Keven, can you give us an idea about how the numbers broke down in 2013? How much capital was raised, and where was it coming from?
Sure. So 2013 was an active year. Essentially, REITs raised about the same amount that they did in 2012, somewhere in the neighborhood of 65 billion. Breakdowns between different types of capital, common equity, senior debt, preferreds, largely similar 2013 to 2012. One slight change is that the amount of preferred equity that was raised was slightly less, and the amount of senior debt that was raised was slightly more. So just suggests there was sort of differing investor appetites. And it was interesting to see that despite all the concern about higher interest rates, REITs were still very comfortable tapping the unsecured debt markets out there. So it'll be interesting to see how 2014 shakes out.
Yeah, Keven, I'm glad you brought that up. Interest rates, obviously, that was a big story throughout the entire economy in 2013, but REITs, that didn't seem to deter them from tapping the debt markets. What do you think was driving that?
Well, pricing is still pretty favorable, I mean, compared to history. We've seen the 10-year the rates on the 10-year go up pretty dramatically, but still, compared to a lot of historical periods, rates are generally still pretty darn low. So, in the nature of the REIT structure is that you're regularly back in the capital markets, and whether you're using capital to finance growth or you're refinancing debt, you're going to be regularly back in the markets. And I think a lot of these companies are still finding that despite the rise in interest rates, that they're still able to refinance at attractive rates. They've got higher interest rate debt coming in, and as long as there is an appetite among investors and they feel like they have a decent use of capital and it will keep their balance sheets clean, it makes a ton of sense for them to continue to tap the capital markets.
And, following the financial crisis last decade, one of the big stories that a lot of analysts, investors kind of focused in on with REIT management teams is how good of a job they did delevering balance sheets, kind of configuring their capital structures. Now that they're taking on more leverage, I mean, do you have any worries about, possibly management teams losing sight of some of the lessons learned?
It's the leverage levels are slightly higher when you compare them to the company's market cap. The stocks didn't perform as well as we had hoped last year, particularly compared to the broader equity market. So if you compare a company's debt load to its market cap, it's going to fluctuate based on what's happening in the stock market. I think if you compare it to the value of the underlying assets, I don't think there's a lot of concern about excessive leverage there. I mean, these companies are about 40% levered, and I'd say that's pretty conservative. To me, the most important thing that we've seen over the last few years, as you noted, was the fact that the companies have cleaned up their balance sheets. The economy is not producing job growth the way we would like to see, so the demand side of the real estate equation is still not quite there in a lot of markets. But I think these companies are really well positioned to take advantage of a recovery in the markets. They've got very manageable balance sheets for the most part. Their debt is hedged, so interest rate risk should be fairly nominal. They've got plenty of room on their credit lines, so they should be in a position to take advantage of the right growth opportunities when they come along.
Okay, finishing up, Keven, go ahead. Forecast 2014 for us. Do you think that REITs will still find the capital markets pretty inviting?
There's no reason to think things will change dramatically. Certainly, if the Fed aggressively raises interest rates, that will change the environment. REITs do get hit pretty hard when there's increased concern about the Fed. But the reality of what we've seen over the past couple of years is that there has been plenty of investor appetite for equity offerings. We've seen a fairly robust IPO activity. And they've had fairly consistent access to the debt markets, and I don't see anything on the near-term horizon that's going to change that.
All right. Well, Keven, thank you so much for the update. Really appreciate it.
Sure, Alan. Take care.
And thank you all for joining us, too. For REIT.com, I'm Alan Kenny.